Disclaimer.
January 29th, 2026. Silver just hit $120 per ounce, up 274% from $30 1 year ago. While you were watching stock market headlines, something happened that changes everything for anyone holding precious metals or planning to buy them. 3 days ago, industrial buyers started reporting they can't source silver at any price, which sounds impossible in a functioning commodity market. The U.S. Mint delayed 2026 Silver Eagles indefinitely, and if you try calling major dealers right now, you'll find they've gone completely sold out of standard products that used to ship within days. But here's where it gets interesting. If you check Shanghai's physical silver market right now, metal is trading at $131 per ounce. That's 13 more than the paper price in New York. Think about that scenario for a moment. When was the last time you saw a commodity where buyers in Asia are paying $13 more for the exact same ounce of metal that's supposedly available in American markets? This isn't normal volatility where prices swing on speculation or economic data releases. This is what a government takeover of a commodity market looks like in real time. And here's what they're not telling you on financial networks. President Trump activated the Defense Production Act for silver. You probably remember that law from COVID when it forced companies to manufacture ventilators and masks. But the Defense Production Act is actually a Cold War weapon that gives our government first access to all domestic production of strategic materials. The question facing every American who owns silver isn't if civilian sales get restricted. The question you should be asking yourself is, did it already happen and nobody noticed? Let me show you the legal framework that just changed everything. In March 2025, Trump signed Executive Order 14241, invoking Defense Production Act Title III for critical minerals. That's the section that lets government redirect private industry toward national security priorities. Then, in May 2025, a presidential waiver quietly removed the $50 million congressional approval requirement that used to limit how much money could be spent without oversight. You didn't see headlines about that change, but it meant billions could flow into strategic material purchases without public debate or legislative scrutiny. Now, here's the third layer that should grab your attention. This January, a new executive order explicitly authorized the Secretary of Defense to use available enforcement actions under the Defense Production Act for strategic materials. According to the Federal Register filing, that created a 3-layer legal framework where silver, which became an official critical mineral as of November 2025, can be redirected from the civilian market through something called DPAS priority ratings. These aren't requests or suggestions. DPAS ratings make government contracts mandatory, while civilian orders get deprioritized or delayed indefinitely. What does that mean for you? If you own a mining company or refinery and receive a DPAS-rated contract from the Department of Defense, you must fulfill it before any private customer orders. Refusal brings penalties and potential facility seizure under wartime provisions that never actually expired. Our government just built the legal infrastructure to redirect America's entire silver supply chain away from investors, jewelers, and industrial users who aren't making missiles or submarines. The current price disconnect reveals this allocation is already occurring behind closed doors. Shanghai's physical market at $131 versus COMEX paper at $118 shows a 13% premium, but when you dig into regional physical markets, the picture gets even more dramatic. China is paying 100% premium over paper prices. Japan is paying 60% more. Dubai markets show a 40% premium. Meanwhile, U.S. dealers are reporting something they describe carefully in private conversations. Entities representing defense contractors are placing classified orders for tens of thousands of ounces at a time. Think about this from a dealer's perspective. You've been in the precious metals business for 20 years, you know your regular customers, you understand normal order flow patterns. Then suddenly you're getting calls from buyers who won't identify their end clients, who want immediate delivery of massive quantities, and who don't seem to care about price when you quote them $130 or $140 per ounce. These aren't retail investors or small businesses. According to confidential dealer sources who spoke on condition of anonymity, these are institutional buyers with government connections. And their orders get filled while your order for Silver Eagles sits in backlog for months. The U.S. Mint isn't even pretending things are normal anymore. Their official statement cites rapidly increasing prices as the reason for delaying 2026 Silver Eagle production. But subscriptions sold out before they even released the coins this year. Pop quiz. When was the last time you saw the U.S. Mint unable to produce America's official silver coin because they couldn't secure enough silver? The Mint is backed by the U.S. Treasury. They have government purchasing power. They operate the coin production facilities at West Point and Philadelphia. If they can't get silver, what does that tell you about civilian availability in coming months? Here's another indicator that professionals watch, but retail investors often miss. Silver lease rates just spiked to 8%, and if you're not familiar with lease rates, let me put this in perspective. Lease rates represent what it costs to borrow physical silver for short-term delivery, and historically these rates stay near zero because silver is abundant and easy to source. When lease rates spike to 8%, it indicates physical tightness, where someone is absorbing all available supply faster than mining production can replace it. Banks and refineries that normally lend silver to manufacturers and traders are suddenly unwilling to let metal leave their vaults, which only happens when they know reacquisition might be impossible at reasonable prices. Now, let me explain the Defense Production Act powers that most Americans don't know exist because we've never had to use them at this scale. Title: I gives the President authority to require businesses to prioritize government contracts through those DPS ratings I mentioned. These ratings aren't polite requests. They're mandatory, and refusal brings serious consequences, including fines and facility seizure. Title III authorizes our government to sign off-take agreements that lock up future mine production before it ever reaches public markets. Imagine you operate a silver mine in Nevada producing 2 million ounces annually. Under Title III, the Department of Defense can offer you financing for expansion in exchange for delivery commitments that obligate your next 5 years of output directly to government warehouses. Title VII requires private companies to report their inventory levels, customer lists, and production capacity to federal authorities. Think about what that means if you're running a refinery or distribution company. The Department of Defense can legally demand you disclose how much silver you have, who you're selling it to, and what your manufacturing capabilities are. If they decide silver is a strategic national security priority, and the executive orders suggest they already have, they can redirect our entire domestic supply chain. We're talking about 35 to 40 million ounces per year of U.S. mine production that could be legally diverted away from civilian markets. But wait, there's more authority you need to understand. The DFC, that's the Development Finance Corporation, which most Americans have never heard of, now has delegated authority to spend billions buying silver without congressional approval. This authority comes from the national energy emergency that was declared in January 2025, and here's what's brilliant about how this was structured. By framing silver acquisition as part of energy infrastructure and national security, the administration bypassed normal legislative oversight. The DFC can write checks for strategic material purchases the same way it finances overseas development projects, except now they're buying metal that affects your portfolio and purchasing power. Have you noticed how quiet mainstream financial media has been about these developments? CNBC talks about silver hitting $120 like it's just another commodity rally driven by industrial demand or inflation hedging. Bloomberg mentions supply tightness, but doesn't connect the dots to Defense Production Act implementation. The Wall Street Journal covered the executive orders when they were signed, but hasn't followed up on how those legal authorities are actually being deployed in real time. You're not getting the full story from traditional financial journalism because the story is unfolding in federal contract announcements, dealer inventories, and premium spreads that require connecting multiple data points. Let me be direct with you about what we're watching unfold. Our government just built and activated the legal infrastructure to control America's silver market. They did it using executive orders that didn't require Senate confirmation. They funded it through existing agencies that don't need annual congressional appropriations for each purchase. They are implementing it through DPAS priority ratings and offtake agreements that happen behind closed doors without public disclosure until after contracts are signed. And the price action, silver up 274% in 12 months with physical premiums exploding worldwide, tells you the market knows something is fundamentally different this time. Shanghai trading $13 above New York isn't an arbitrage opportunity. It's evidence that physical metal has already decoupled from paper contracts, and Chinese buyers are willing to pay that premium because they understand what we're only beginning to recognize. When governments start treating silver as a strategic asset instead of a commodity, the rules change. Availability becomes more important than price. Delivery becomes more valuable than contracts. And American investors who waited for confirmation from CNBC or their financial advisor might discover they waited too long. The Defense Production Act isn't some theoretical emergency power sitting unused in legal archives. It's active policy executing right now while silver hits $120 and retail investors are still trying to figure out why their orders are not shipping. The framework is in place, the funding is authorized, the priority ratings can be issued tomorrow if they haven't been already. And every ounce that flows to defense contractors or strategic reserves is one less ounce available for your investment or your business. What happens next depends on whether you're paying attention to what our government just told us through actions rather than words. They told us silver matters for national security. They told us they're willing to use Cold War legal powers to secure supply. They told us civilian access isn't guaranteed when military needs conflict with market demand. The only question is, are you listening? Let me show you why our government has no choice but to act, and why the math behind global silver supply makes this crisis inevitable regardless of who sits in the White House. Every Tomahawk missile contains a classified amount of silver in its guidance systems. Reports from defense industry sources suggest anywhere from 10 to 500 ounces, depending on the missile model and sophistication level, but the Pentagon doesn't publish exact figures for obvious security reasons. Virginia-class submarines use tens of thousands of ounces of silver throughout their electrical systems and weapons platforms. F-35 fighter jets rely on silver in radar systems and avionics, where conductivity and reliability cannot be compromised by cheaper alternatives. Think about satellite solar panels that keep our GPS and communication networks functioning. Think about drone circuit boards that make modern warfare possible. Think about the electronics in nuclear weapon triggers, where failure isn't an option. Now think about this sobering fact. The United States depleted its last strategic silver stockpile in 2002 when we sold the final 165 million ounces to produce silver eagle coins. We're currently 64% to 80% import dependent for silver, with most of our imports coming from Mexico, which supplies 47% of what we bring in, followed by Peru and Chile. But here's where our vulnerability becomes a national security nightmare. China controls 60% to 70% of global silver refining capacity. You mine raw silver ore in Mexico or Nevada, but you need specialized refineries to turn that ore into 999 fine silver bars that manufacturers can actually use. Most of those refineries are in China, which means the same country we're competing against for technological and military dominance controls the processing choke point for a metal our defense industry desperately needs. The House Select Committee ran war games last year, simulating a conflict with China over Taiwan. According to their findings, the United States would exhaust its advanced missile stockpile in less than 1 month of sustained combat operations. Let that sink in for a moment. 1 month. Pentagon contractors have been urged to double or even quadruple munitions output to rebuild our depleted weapons inventories. But you can't manufacture precision-guided missiles without silver, and you can't rebuild stockpiles if the metal isn't available at any price. Now, let me walk you through the supply crisis that's been building for 5 consecutive years, while most investors were focused on gold and Bitcoin. In 2025, global silver mine production totaled 835 million ounces, which sounds like a lot until you compare it to the 900 million ounce peak we hit back in 2016. Mine production has been declining because prices stayed suppressed for years below the cost of discovering and developing new deposits, so mining companies stopped investing in exploration and expansion. Meanwhile, industrial demand alone consumed 550 to 600 million ounces in 2025. Solar panel manufacturers are using 15 to 20 grams of silver per panel, and global installations exceeded 260 gigawatts last year as countries race toward renewable energy targets. Electric vehicles contain 67% to 79% more silver than traditional combustion engine cars. Because EVs require extensive wiring, battery management systems, and power electronics, where silver's conductivity is irreplaceable. Semiconductor fabs and AI data centers are consuming unprecedented amounts of silver in high-performance computing applications, where copper simply can't match the performance characteristics engineers need. Do the math with me. If we produced 835 million ounces and industrial demand took 550 to 600 million ounces, that leaves only 235 to 285 million ounces for investment, jewelry, photography, and every other use combined. But the deficit is actually much worse than that single year suggests. The cumulative deficit from 2021 through 2025 totaled 820 million ounces. That's equivalent to an entire year's worth of global mine production that got drained from above-ground stockpiles that took decades to accumulate. Where did that 820 million ounces come from? It came from drawdowns of COMEX warehouse inventories, London vaulted silver, ETF holdings that got liquidated, and private stockpiles that long-term holders sold when prices rose. Think of it like draining your savings account to cover expenses that exceed your income. You can do it for a while, but eventually the account runs dry and there's no more buffer. We're approaching that moment in silver markets where above-ground stocks have been depleted to levels that see and absorb another year of structural deficits. The 2026 deficit is projected between 95 and 200 million ounces as China's export restrictions kick in. On January 1st this year, China implemented new licensing requirements that effectively block 120 million ounces annually from global markets. Any refinery or producer that wants to export silver from China now needs a minimum production capacity of 80 tons and must obtain government approval for each shipment. That's not a free market regulation. That's strategic resource control designed to keep Chinese silver in China for their own industrial and monetary purposes. Shanghai futures exchange inventories hit their lowest level since 2015. London vaults, which have historically held 300 to 400 million ounces available for delivery, now report they have 30 to 45 days of supply remaining at current withdrawal rates, What happens on day 46 when industrial manufacturers, defense contractors, and investors all show up demanding metal that isn't there? This is not hypothetical future speculation. This is math that plays out over the next few months based on inventories you can verify right now. Let me show you the ground-level evidence that confirms systematic supply diversion is already happening. COMEX registered inventories collapsed 70% since 2020. Registered inventory means silver that is available for physical delivery against futures contracts, and we're currently sitting at roughly 40 million ounces. That might sound like a reasonable amount until you realize COMEX trades hundreds of millions of ounces in paper contracts every month. And if even a small percentage of contract holders demand physical delivery, the exchange runs out of metal almost immediately. Money Metals Exchange, one of America's largest precious metals dealers, reported on January 5th that most dealers are completely sold out of eagles, maples, and generic silver rounds. I'm not talking about temporarily out of stock with new shipments arriving next week. I'm talking about dealers unable to source product from their normal wholesale suppliers who are themselves unable to get metal from refineries operating at capacity but unable to secure enough raw material to meet demand. Anonymous dealer sources, speaking on condition they not be identified by name or company, describe entities representing defense contractors placing massive classified orders. Think about what classified means in this context. A defense contractor can't tell the dealer what the silver is being used for, can't disclose which government agency authorized the purchase, and doesn't care about negotiating price because they're operating under a priority contract that guarantees reimbursement. These orders get filled immediately while your order for a monster box of silver eagles sits in backlog indefinitely. One major wholesale distributor froze their purchasing operations in early January, and when asked why, their response was carefully worded. Their legal team instructed them to reserve capacity for potential government priority orders under DPS regulations. Read between those lines. The company isn't saying they received DPS-rated contracts yet, but their lawyers are telling them to prepare for that possibility by not committing inventory to civilian customers who might have to be displaced later when mandatory government orders arrive. While American dealers struggle with supply, Russia made a stunning announcement last month. Their central bank is allocating funds for silver purchases for the first time in 70 years. Russia abandoned silver as a monetary reserve back in the Soviet era, and now they're suddenly buying again. When central banks change 70-year policies, they're not reacting to short-term price moves or technical trading patterns. They're positioning for a fundamental shift in how the global monetary system values strategic commodities. The gold-silver ratio tells you how many ounces of silver it takes to buy 1 ounce of gold, and this ratio has been compressing dramatically. In early 2025, the ratio stood at 100.1, meaning gold was 100 times more valuable per ounce than silver. That ratio is now compressed to 42.1, which represents the fastest revaluation of silver relative to gold since the 1970s inflation crisis. Markets don't move like this on speculation alone. This is institutional money, sovereign buyers, and major industrial consumers fighting for limited supply. Backwardation in silver futures markets has reached the deepest level since 1980. If you're not familiar with backwardation, let me explain why this matters. Normal commodity. Futures markets operate in contango, where future delivery months trade at higher prices than spot because of storage costs and carrying charges. Backwardation means the opposite. Buyers are paying a premium for immediate physical delivery over promises of future delivery. When backwardation persists and deepens, it proves the market cannot clear at current prices because physical metal is so scarce that owning it today is worth more than a contract promising delivery in 3 or 6 months. What does all this mean for you? It means the largest silver deficit in modern history is unfolding right now, while most investors are still getting their information from financial media that treats silver like just another commodity. Your financial advisor probably mentioned gold when you discussed inflation protection, but I'd bet they haven't called you urgently about silver supply chain collapse. The institutions that manage billions in assets are quietly accumulating physical metal through private dealers and direct mining company relationships, while retail investors wait for confirmation from CNBC that never comes. The Pentagon can see these numbers, just like we can. They know our missile factories need continuous silver supply. They know China controls refining capacity and just restricted exports. They know domestic mine production can't meet military demand without displacing civilian users. They know our strategic stockpile is gone and rebuilding it requires acquiring hundreds of millions of ounces in a market that's already running deficits. And they know the Defense Production Act gives them legal authority to solve this problem by redirecting private sector supply toward national security priorities. This isn't about conspiracy theories or secret government plots. This is about mathematical reality colliding with geopolitical necessity. When industrial demand plus investment demand exceeds mine supply for 5 consecutive years, something has to give. When the world's largest military needs a metal it doesn't stockpile and can't reliably import, that military's government will act. When China locks down exports and Russia starts buying, American policymakers have to respond. The only question was timing, and the executive orders issued over the past year tell you timing is now. Now, let me show you the mathematical endgame that forces a price explosion, regardless of whether you believe government intervention is happening or not. We have 835 million ounces of annual mine supply trying to satisfy 600 million ounces of industrial demand that manufacturers cannot reduce without shutting down solar panel factories, automotive plants, and semiconductor fabs. Then subtract government strategic buying from Russia, China, and potentially the United States. Then subtract investment demand from ETFs that increased their holdings by 150% in 2025 from U.S. retail investors who bought 1.5 billion ounces between 2010 and 2024, and from India, where consumers purchased 840 million ounces over the same period. When you do that subtraction, you get negative available supply. Not scarce supply or tight supply, mathematically negative supply where more ounces are being claimed than exist. Markets eventually solve these imbalances through price, and here's what the price solution looks like based on historical relationships and current trajectories. If gold reaches $5,000 per ounce, which multiple analysts project within 12 to 18 months, and the gold-silver ratio reverts to its historical band of 55.1 to 65.1 silver, mathematically targets $75 to $90 per ounce just from that relationship alone. But sovereign accumulation transforms silver from a commodity into a strategic asset. And that's when scarcity premiums kick in that have nothing to do with industrial supply and demand. Look at what happened to uranium after it received critical mineral designation and governments started securing supplies for nuclear power build-out. The uranium price saw a multi-year surge that took it from $30 per pound to over $100 as strategic buyers removed material from commercial markets. Lithium followed a similar pattern when battery demand coincided with government stockpiling and mine nationalism in South America. Silver is following this exact playbook right now. The Defense Production Act Section 303 specifically authorizes our government to create, maintain, and expand domestic industrial base capabilities for critical materials. That language permits the creation of a strategic silver reserve parallel to the strategic petroleum reserve, the 714 million barrels of oil that we maintain for energy security. If the U.S. government decides to establish even a modest strategic reserve of 100 to 500 million ounces through mandatory purchases and offtake agreements, where does that metal come from in a market already running deficits? It comes from pushing price high enough to ration civilian demand and incentivize every ounce of scrap recycling and marginal mine production. It comes from breaking the paper futures market, its ability to suppress prices when physical delivery becomes impossible at COMEX prices. Think about what happens when physical markets in Shanghai, Tokyo, and Dubai are trading $20 to $30 above New York futures prices. At that point, the futures market loses its credibility as the price discovery mechanism, and real transactions start settling based on physical availability rather than paper contract specifications. The mathematical target, based on deficit economics and strategic demand, pushes silver toward $150 to $200 per ounce over the next 12 to 24 months. Not because of inflation or monetary debasement alone, but because physical scarcity forces price to the level where supply and demand can actually clear. At $150, maybe do you think twice about buying silver for jewelry? At $150, maybe some industrial users find substitutes for non-critical applications. At $150, maybe some long-term holders sell to lock in gains. But at $108 with Shanghai already at $131, the market is telling you current prices cannot ration demand to meet available supply. Now let me walk you through 3 scenarios for how this unfolds over the next 6 to 18 months, because understanding these scenarios determines whether you protect your wealth or watch opportunities vanish. I'm assigning probability percentages to each scenario based on current policy trajectory, supply conditions, and geopolitical factors, and you need to prepare for the most likely outcome rather than hoping for the best case. Scenario 1 is voluntary cooperation, and I give this only a 20% probability with a timeline of Q2 2026. In this scenario, our government secures 200 to 300 million ounces through negotiated offtake agreements with U.S., Canadian, and allied mining companies. They use subsidies and accelerated permitting to incentivize production increases. They launch a voluntary buyback program offering $130 to $150 per ounce, which is above current market prices, to encourage large holders to sell to strategic reserves rather than competing with government buyers in open markets. The civilian market continues to function in this scenario, but you're paying 30% to 50% premiums over spot prices. Experiencing allocation delays of several months from order to delivery and waiting 4 to 6 months for mine to market delivery as production ramps up. This is the soft landing where the Defense Production Act is used as a bargaining tool and negotiating leverage rather than as a weapon to commandeer supplies. Companies cooperate because the financial incentives make sense and because the alternative of mandatory DPAS orders is worse. Scenario 2 is allocation controls, and this is where I see 60% probability with implementation ongoing throughout 2026. In this scenario, DPAS priority ratings get issued to all defense contractors and critical infrastructure suppliers, creating a two-tier market where military and government needs get instant delivery while civilian purchasers wait months or get priced out entirely. Import and export controls prevent silver from leaving the United States without special licenses, which protects domestic supply for American users but cuts off international arbitrage that normally equalizes global prices. Mexico's environmental regulators, potentially under pressure from U.S. trade negotiations, force shutdowns at major silver mines for violations that previously would have resulted in fines rather than closures. Remember, Mexico is the world's largest silver producer, and even temporary disruptions of 50 to 100 million ounces per year create massive global shortfalls. Lease rates spike above 10% as banks and bullion dealers refuse to lend metal they know they cannot replace. Physical premiums widen to 50% to 100% above paper prices as COMEX loses its role as price discovery mechanism to Shanghai, Dubai, and Tokyo markets, where physical transactions actually clear. This is the managed crisis scenario where silver remains available in theory but becomes functionally restricted in practice. You can technically buy silver, but your order sits in queue behind government priority contracts. You can technically import silver, but the licensing process takes months and requires documentation proving non-strategic end use. You can technically sell silver, but finding buyers becomes difficult because refineries are processing government material first, and dealers have limited capacity to take on new inventory they cannot flip quickly. Scenario 3 is emergency acquisition, and I assign this 20% probability triggered by an acute crisis, war with China over Taiwan, a dollar collapse that threatens reserve currency status, or a banking crisis that forces government intervention in commodity markets. In this scenario, the Full Defense Production Act gets invoked to nationalize the silver market through mandatory sales to government at a fixed price that's probably below current market value. Civilian sales get frozen under the Trading with the Enemy Act, which was used in 1933 for gold confiscation and remains legal today, despite its archaic name. Hoarding penalties get implemented with fines of $10,000 and prison sentences up to 10 years for refusing to sell to government buyers. Your existing purchase contracts get cash settled at suppressed prices rather than delivering physical metal because the government has exercised emergency allocation powers. This is the worst-case scenario that requires an actual national emergency, where our government treats silver like wartime strategic material, similar to how copper and aluminum were controlled during World War II. I want to be clear with you. I don't think Scenario 3 is likely in the near term, but you need to understand it's legally possible and the framework exists. The fact that our government spent decades maintaining these emergency powers and recently updated them with executive orders tells you they're taking the possibility seriously, even if it remains a tail risk for most of us. So what do you do right now with silver at $120, physical premiums exploding, and these 3 scenarios playing out over the next 6 to 18 months? Let me give you the action plan for the next 90 days that separates people who positioned correctly from those who waited too long. If you already hold physical silver, do not sell. The fact that our government is building infrastructure to acquire your metal means they recognize scarcity that casual investors haven't fully priced in yet. Selling now might lock in impressive gains, but it may also prevent you from buying back later if Scenario 2 or 3 occurs, and civilian access becomes restricted. Remember, you can always sell later if you're wrong, but you cannot buy physical delivery if dealers are sold out or allocation controls are implemented. If you're a new buyer considering entry, understand you're facing entry risk versus unavailability risk. Entry risk means silver could pull back to $100 or even $90 if paper markets temporarily stabilize or if government buyback programs flood supply in the short term. Unavailability risk means waiting for that dip could result in complete lockout if allocation accelerates and physical delivery becomes impossible at any reasonable price. Shanghai is already at $131 and U.S. markets are catching up. Every week you wait might be a week closer to dealers unable to source metal. Here's what you must avoid regardless of current holdings or new purchases. Paper silver, SLV and other ETFs, unallocated accounts at banks, and futures contracts all carry cash settlement risk if government prioritizes physical delivery for defense applications. When push comes to shove and vaults run dry, you'll receive dollars based on some suppressed settlement price rather than ounces you can hold. Paper is fine for trading price moves, but for strategic holdings over the next 2 years, only physical metal in your possession or fully allocated storage provides certainty. Diversify your storage jurisdictions if you have significant holdings. If the United States implements scenario 2 or 3 controls, having metal stored in Singapore, Switzerland, or Canada provides options and flexibility. Focus on recognizable forms that maintain liquidity under stress. Government-minted eagles and maples, bars from major refiners like Sunshine or Asahi. When restrictions tighten, buyers want metal they can verify and trust without expensive assaying. Now let me give you the leading indicators to track over the next 90 days so you're not flying blind. Watch COMEX registered inventory depletion rate. We're currently at roughly 40 million ounces, and if that drops below 20 million, it signals the exchange is approaching the point where any significant delivery demand could force cash settlement or trading halts. Watch for US Mint product delays extending beyond February. The Mint has already delayed 2026 Eagles indefinitely, but if other products like bars or commemoratives get delayed, it confirms supply diversion is accelerating beyond just coins. Monitor the Federal Register for DPAS contract announcements. When the Department of Defense issues priority ratings for silver purchases, they must publish notices in the Federal Register under procurement transparency rules. You won't get details about quantities or end uses, but you'll see which contractors are receiving mandatory fulfillment orders. Watch Shanghai's premium over COMEX. Right now it's $13, but if that exceeds $20 to $30 consistently for weeks, it means the paper market has completely lost credibility and price discovery is shifting to physical markets where real supply and demand meet. These indicators give you real-time intelligence while government policy unfolds behind closed doors. You don't need insider access or classified briefings to see what's happening. You just need to watch the data points that professional traders monitor, while retail investors rely on CNBC commentary that's always 3 months behind reality. The Defense Production Act is not a theoretical emergency power sitting unused in legal archives waiting for some future crisis. It's active policy executing right now while silver hits $120 and retail investors discover too late that available for sale does not mean available for delivery. The framework is in place through those 3 executive orders we discussed. The funding is authorized through the DFC and existing emergency declarations. The priority ratings can be issued tomorrow morning if they haven't been issued already under classified procurement. Every ounce that flows to defense contractors rebuilding missile stockpiles is 1 less ounce available for your portfolio. Every ounce that goes into a strategic reserve is 1 less ounce available when you try to buy next month. Every day that Shanghai trades at premiums to New York is another day that paper prices become meaningless compared to physical reality. The US government just told you silver is a national security priority through actions that speak louder than any press release or policy statement. China told you by restricting exports for the first time in modern history. Russia told you by buying silver for reserves after 70 years of treating it as irrelevant. The market told you with $120 prices and physical premiums approaching 100% in some regions. The only question remaining is, are you listening? Subscribe, because what happens in the next 90 days determines whether you are holding wealth insurance that protects you through currency debasement and strategic shortage, or whether you are watching from the sidelines as the greatest metal shortage in modern history unfolds and civilian access gets progressively restricted. The information is public, the math is clear, the policy framework is documented. You have everything you need to make an informed decision. The question is whether you'll act before allocation makes that decision for you.